In this video, we'll be looking at asset classes. This is an introduction in our How to Trade Essential series, and some of the objectives discussed in the video include what the main asset classes really are. We'll look at analyzing different asset classes, and we will finish with a stress upon the importance of diversifying with respect to different asset classes. So, investments can be divided into different types of investment known as asset classes, and different asset classes can have different characteristics and thus they can behave differently too. Many traders will specialize in a particular asset class rather than trying to trade lots of different asset classes, although it is possible to apply some methods of analysis to virtually all securities irrespective of asset class. There are a lot of different asset classes different classes of financial asset. Some have existed for centuries, like stocks and bonds, and some are relatively new, like cryptocurrencies, if you have heard of them before. And there are 8 main asset classes, which we will look at briefly. So the first one, we've got stocks, we've got currencies, otherwise known as foreign exchange or FOREX to most in that community. You've got commodities, bonds, cryptocurrencies, futures, options, and ETFs. So let's begin with stocks. Stocks, or shares, are one of the most popular assets to trade or invest in. Shares represent ownership of a fraction of a company, and the owner is therefore entitled to their share of the profits in the business. Shares of businesses which are listed on a stock exchange, a public stock exchange, can be traded, but not all businesses are publicly traded. It is not possible, or very difficult rather, to trade shares of privately listed companies. The term equities also refers to stocks, since stocks represent an equity stake in a business. Currencies, otherwise known as foreign exchange, are another very popular asset class to trade. Participating in the foreign exchange, or FOREX for short, involves betting on the value of one currency against another. So for example, the euro against the dollar, the EUR/USD, euro against the dollar. Not to be confused with the euro dollar, which is just a way to measure international deposits of the US dollar. The euro dollar is not the euro against the dollar, but the EUR/USD, euro/USD, euro against the dollar, that is a currency pair. Don't get confused with the euro dollar or euro dollar deposits. Okay, so currencies can vary from other asset classes in that currencies are bought or sold relative to another currency. You can see here with the euro against the US dollar, they are bought or sold relative to one another. The euro is bought relative to the dollar in this case. So for example, you don't just buy the British pound, you buy the British pound relative to another currency, like say the Canadian dollar. You can also buy or sell a currency relative to a basket of other currencies, like the US dollar index. And forex markets are extremely liquid, meaning enormous amounts of currency are traded every single day. For commodities, they are basically raw materials, and many can be traded on public exchanges just like other asset classes. Examples of commodities include metals like gold or silver, agricultural products like coffee or wheat, and other natural resources such as oil and or maybe natural gas too. And commodities are commonly traded via futures, options, or ETFs, which we'll cover just shortly. But for now, we'll look at bonds. These financial instruments are another important part of the financial system. Buying bonds is a way to own debt, usually owed by governments or corporations. So a government could issue bonds and then pay that debt back at a future date. A business that would like to raise money could issue bonds at, say, a rate of 5% a year. They issue a certain amount, they pay that interest back to their bondholders, kind of like shareholders, but bondholders. Bonds vary in risk as well. So, in essence, by buying bonds, you lend money to a government or a corporation that says they will pay you back with interest, and that's assuming they don't default. Default essentially means that a business will not be able to pay its debt back. If they can pay their debt, then they'll pay you back with interest. And bonds differ in terms of riskiness. And like all securities, bonds on secondary market exchanges fluctuate in price, but also issue regular coupon payments as compensation for holding the debt. Bonds have expiry or maturity dates. You'll probably see the word maturity used a lot. It just means the expiry date, upon which the principal amount is paid back to the bondholder. So unlike stocks, bonds at some point will expire. The time frame for expiry varies on the type of bond. You can have longer term bonds such as 10 and 30-year ones. For example, the 10-year treasury bond will expire after 10 years, and the money owed will be paid back to whoever owns the bond, which could be many different parties. A 30-year treasury bond will expire 30 years after it is issued. You also have shorter term bonds, or rather they call them bills, shorter term instruments with an expiry below 12 months. So a 6-month instrument, a bond instrument, say a 6-month loan at a very low interest rate, but it makes sure that it's worth more than, say, the investor not taking part in it. Cryptocurrencies are a relatively new asset class, and they became quite popular, extremely popular rather, in the crypto boom. One would really argue that they have become extremely popular, as we'd seen the value of coins like Bitcoin and Ethereum explode before they peaked in late 2017. Cryptos generally tend to be much more volatile than any other asset class that you'd come across. In fact, they're historically very volatile, and there's not much research regarding this type of asset to kind of suggest what the benefit of being invested, or rather the risks, the downsides of investing are. At the moment, most tend to trade it on a technical perspective, taking advantage of sentiment, and they just try and trade breakouts, breakdowns, all sorts of kind of simple setups, but it is a very liquid market. One would think about maybe the situation of third world countries trying to change currency from, say, their local currency that has huge inflation. What I've noticed from looking around myself, they tend to buy into crypto and then switch it to another currency through easier means. It's very difficult to change, say, the home currency in a place like Venezuela to dollars without having a lot of risk. But with cryptocurrencies, there's a slightly easier kind of secondary market where we tend to see a lot of volatility here too. Crime also seems to be an interesting source of liquidity for cryptocurrencies. Why? Because you can't generally track most ledgers. Now for futures, these are a type of derivative which are contracts based on some underlying asset, which may be a stock or a bond or a currency, etc., all sorts of things. Futures obligate, or these contracts, they obligate the owner to purchase the underlying asset at a predetermined price and time in the future. So, for example, a contract may state that the holder of the contract will buy 100 ounces of gold in 3 months for $1,400 an ounce. And these contracts, these futures contracts, are a way of locking in prices so that businesses that rely on purchasing assets in the future can know what they will pay way in advance. It's security for a business. You could do this with oil. Make sure that you're buying at the price that you are comfortable with buying at. Say if the price changes, then you have to reevaluate all your financials. So it's better to use such futures contracts to be more stable in terms of understanding your cost base. So you pay way in advance instead of having to pay whatever the market price is when they need the asset. If I owned a futures contract to buy gold at $1,400 an ounce and the market price of gold rose to $1,500 an ounce, my contract enables me to still buy at the $1,400 an ounce price, which was locked in when I acquired that contract in the first place. And futures contracts can be bought and sold as securities before they expire. Their values will rise and fall as the contracts themselves are traded in the markets. With options, this is another type of derivative, options. Like futures, options contracts can be used to lock in a price to buy an asset at a specified time in the future. This is a little bit different because unlike futures, the contract holder does not actually have to buy the asset upon expiry. You have the right, but you don't have the obligation when you're trading with options. Hence the word options. You have the option to buy and sell. So call options, we won't go too much into options at the moment. We'll have a separate area on that very soon. But call options give the holder the right to buy the asset at the strike price, whereas put options give the holder the right to sell. So if I'm buying call options, I'm buying the right to buy, not the obligation, but I can buy upon expiry if I want to. So by trading options, you won't need to put up as much capital, but if it expires and you choose to exercise your right, then you'll be having suddenly a lot more capital at work. But with an option, you could buy and sell an option, make your money and leave without having to put up the full capital of, say, buying 100 contracts of, ES, many futures, all sorts of things. You could save yourself having to put up that much money and still capitalize on the move, say by buying the right to buy, selling the right to buy, which means essentially shorting call options, selling call options. You could buy the right to sell, so buy puts, or you could sell the right to sell, so by selling puts. We'll now look at ETFs. An ETF can be thought of as a basket of different securities. When you buy the ETF, you get exposure to all of the assets within the ETF. And these ETFs contain a basket of related assets. So like shares of companies in the same sector or things tracking a stock index. So let me give you an example. Let's say I wanted to buy a large variety of large cap US stocks, so highly liquid stocks. Instead of having to buy each stock individually, I could buy an ETF which tracks the S&P 500, an index comprising of the 500 largest stocks in the US. And by doing this, I'm saving myself transaction costs, because imagine buying every single share, and there's like 40 in that ETF set. Well, in the S&P 500, there's 500, let's just say. 500 shares in there to buy a certain amount of each one. It might not even be worth it with transaction costs, but by buying that S&P 500, say Vanguard tracker ETF, you're able to save transaction costs and have the same exposure to the index. ETFs, though, are not only expressed through indexes, right? There are different types. There are lots of different ETFs with baskets of assets based on various criteria. So they can contain a variety of other asset classes, including stocks, commodities, currencies, bonds, and many others. And because of the nature of different asset classes being very different, the methods used to analyze them can also vary greatly. The extent to which the asset class matters depends on the type of analysis. For traders who rely more heavily on technical analysis, charting and all that stuff, the asset class under analysis matters much less. TA is more or less applied in the same way across all asset classes. So with crypto, generally, you'd see most people are using TA because there aren't really fundamental sides to value the assets within. They essentially have very little, if not any, intrinsic value associated with them. Once again, there aren't enough reliable studies released to kind of comment on that. But With things like stocks, futures, you generally use them in a similar way as well. You use them as, at the very minimum, risk management tools. Technical analysis helps you figure out trend, gauge investor sentiment. At the very minimum, it depends what degree you tend to use out of it. But there can be a degree of uniqueness associated with the asset classes, such as cryptocurrencies being significantly more volatile than other assets, and price gaps very rarely occur in extremely liquid foreign exchange or FX markets. But generally, the same analysis can be applied to stocks, bonds, forex, crypto, etc., with respect to technical analysis. Fundamental analysis, on the other hand, varies greatly by asset class. So, for example, the fundamental factors mainly influencing stocks are concerned with the condition of the underlying company. A fundamental analyst trading stocks may be interested in things like the profitability, expansion plans, and the financial position of the company. However, obviously, this won't apply to things like a commodity. A commodity can't be a profitable business. It doesn't, well, it can as a business, but trading the commodity itself doesn't generate a yearly dividend or stuff like that, because a commodity like gold essentially has no underlying business. The fundamental factors affecting commodities will be very different, perhaps relating to agricultural production, consumer preferences, and maybe even weather too. That's an important one with commodities. Weather, yeah, that's a good one too. And currencies too are driven by different fundamental factors. A forex trader may be more concerned with macroeconomic stuff, so the macroeconomic environment of various countries and the actions of central banks. Those activities influence the fluctuations of foreign exchange, that particular asset, much more than most others. They tend to do to others indirectly too, but your main focus as a forex trader is generally on that front. Central bank activity and the macroeconomic environment of various countries with respect to inflation and all sorts of other stuff too. So predominantly, fundamentalist traders will analyze different asset classes in very different ways. And for this reason, it's very common for them to specialize in one type of asset class, like stocks or currencies, and stick to mainly trading those. Hence why you see a lot of futures traders, equities traders, FX traders purely. But being diversified is also important too, which we'll go on to look at right now. One of the most important uses of asset classes is as a means of diversifying a portfolio. Diversifying into multiple asset classes reduces the risk of portfolio drawdown if any particular asset class suffers a significant drawdown. So, for example, a portfolio which only owns stocks will have a large drawdown if the stock market crashes, whereas if one has a diversified portfolio which holds other assets like some commodities or bonds alongside different things, may fare much better during a stock market crash. But you could argue against this and say, hey, if you have a diversified portfolio, what if you're giving up a lot of your returns by having things like bonds or diversified assets? They reduce your returns. But the degree to which your risk is reduced versus the reward you're giving up is important to consider. If you're giving up 20% of your volatility of your portfolio, the risk of your portfolio moving in the other direction, and only giving up, say, 7-8% reward, it might be safer, depending on your own personal risk limits. We've got this term called diversification. Don't diversify for the sake of it, but if it is efficient to do so, then go for it, even if it is at the cost of some of your rewards. We'll talk about things like hedging in the future, where it is essentially a means of diversifying, or at least reducing risk, but it costs, and you can assume it's a thing as if it's insurance, but we'll talk about that on another occasion. But asset classes aren't the only way of diversifying. We could say that it's possible to diversify within an asset class, or to diversify geographically by holding foreign assets as well as domestic ones. You see a lot of people buying shares in different nations as well as their own. Well, sometimes you have the currency risk, which is important to consider. We'll once again cover that on a future occasion, but briefly to cover it here. Say if you own something in dollars and the pound strengthens against the dollar, whether or not your shares are up or down, you have some form of loss as a result of that currency change, because you change back to the pounds, the dollars were weaker in that situation. Sometimes it can benefit you, but you have to also account for other things when trading or investing in different markets too. So to conclude this video, it's really important for any trader to be aware of different asset classes. Whether you're a short-term trader specializing in a preferred asset class or building a long-term investment portfolio depends on your personal preferences, and either is fine. Whether you're on the short-term side with intraday swing trading, day trading, trying to take advantage of volatility, or you're a long-term investor for the future, either is fine, it doesn't matter. But being aware of the opportunities and risks of other asset classes could open you up to a world full of new opportunities.